5, 4, 3, 2, 1.
Today I would like to know about the books called A Random Walk Down Wall Street. Not more than a half a dozen really good books about investing have been written in the past 50 years. This one may be well the classic category. The books consist of 4 parts, 15 chapters. So what's the book all about? Maybe my friend knows about that. Let's ask my friend. Hello, man.
Hi!
What are you doing, guys?
Waiting for you, boss!
Oh, that's great. I want to discuss something about a book called A Random Walk Down Wall Street. Have you read the book?
Yes. The book is written by Burton G. Malkiel. He is an American economist and writer, most famous for his book A Random Walk of Wall Street.
What is the definition of random walk?
Basically, random walk explains that future steps cannot predicted on the basis of past action. If we applied it on the stock market, it means that short-term change in the market cannot be predicted.
After you read the book, what is the definition of investment?
I view investing as a method of purchasing assets to gain profit in the form of predictable income. Can be dividends, interest, or rentals, and or appreciation over the long term.
What is the difference between investing and speculating?
Time period of investment and predictability of investment are distinguished investing and speculating. We must make sure that our investment rate of return is bigger than inflation.
Can you explain about approach to asset valuation?
Yes, basically there are 2 theories, firm foundation theory and castle in the air theory. Firm foundation theory concentrates on intrinsic value. On the other hand, castle in the air focus on physical value.
Is there any situation that people might read about the investment?
Yeah, you can read on the chapter 2. There are many examples about that. For example, the tulip bull crash on the Netherlands, South Sea bubble in England. In South Sea bubble in England, Isaac Newton exclaimed that he can calculate the motion of heavenly bodies, but know about the madness of the people.
And lesson learned about madness of the crowd?
Actually, there are 2 things. First, very sharp increase in the stock price is followed by a gradual decrease to relative price stability. Second, it is not hard actually to make money in the market. What is difficult is avoid temptation to throw your money on short, get rich quick speculative beings.
Does anyone know about technical analysis?
Maybe I can explain that. Technical analysis is the method of the predicting the appropriate time to buy or sell a stock, used by those believing in the castle in the air view of the stock pricing.
What is fundamental analysis?
Fundamental analysis, is the technique that apply of the 10 of the firm of foundation theory to the selection of individual stock.
What can charts tell you?
Okay, I maybe a little bit. I will explain. The first is principle of the technical analysis is that all about earnings, dividends, and the future performance of the company is automatically reflected to in the company past market price. The second is principle that price is tend move in trends. A stock is that rising trends keep on rising, whereas a stock rise tend to remain at rise.
Why might charting fail to work?
Okay, I will explain. First, the chart buy only after price trends have been established, and sells only after they have been broken, because sharp reversal in the market may occur quite suddenly. The chartist often miss the boat. By the time an uptrend signal is signaled, it may already have taken place. Second is, such a technique should be alternatively be safely written. As more and more people use it, the value of any technique depreciates.
What about the techniques of fundamental analysis?
The technician sometimes is interested only the record of the stock price, whereas fundamentalists primarily concerned with what stock is really worth. His most important job to estimate the firm's future value of earnings and dividends. To do this, he must estimate the firm sales level, operating costs, corporate tax rates, depreciation policies, and the source and cost of capital requirements.
Why might fundamental analysis fail to work?
Sometimes there is a potential flaws in the type of analysis. The first is the info on the analysis may be incorrect. The second, the security analyst estimate of the value may be faulty. The third is the market may not correct its mistake, and the stock price may not convert to its value estimate.
So, what is technical analysis in the random walk theory?
Okay, I will explain. Personally, I have never known a successful technician. Technical analysis, I mean that it is anathema to academic work. Yes, history does tend to repeat itself, but infinitely suppressing variety of ways that conform any attempt to profit knowledge is a past price pattern. Second, using a technical analysis for a market timing is especially dangerous because there is a long-term upturn at the stock market. It can be very risky to be cashed.
How good is fundamental analysis?
Wall Streeters, people of Wall Street, feel that fundamental analysis is becoming more powerful and skillful at the time. People in academic community have argued that fund manager and their fundamental analysis can do no better at picking stock than like an amateur. Analysts cannot predict consistent long run growth because it does not exist.
I read an interesting title in chapter 8 about the new walking shoe modern portfolio theory. Would you mind explaining that?
Actually, I don't read this chapter. Maybe my friend Jul will help me to explain. Jul, can you help me to explain this?
Yes. The basic idea of modern portfolio theory is that people should have a diverse selection of investment, and that this investment should maximize the reward while minimizing the risk. Based on Markowitz, portfolio of risky stocks might be put together in such a way that portfolios as a whole could be less risky than individual stock in it.
What is the definition of risk?
In terms of financial, risk is the variance of standard deviation of returns. As long as the distribution of return is symmetric, a dispersion or variance measure will suffice as a risk measure. Risk determines the degree to which return will be above or below average, and thus deciding the valuation of any stock relative to the market. Based on a long-run study, investors have received higher rates of return for bearing greater risk.
Based on the book, How to Reduce Risk?
Diversification will always reduce risk. In practice, a portfolio of 50 equal size and well-diversified US stock can reduce total risk by over 60%. Investors may do better by including stock from emerging markets in their overall mix. Correlation between broad index of emerging market stocks and the US stock market are generally lower than those of the US stock market with developed foreign markets.
What are the type of risk in portfolio?
In portfolio, there are two types of risk: unsystemic risk and systemic risk. The unsystemic risk, which can be diversified away, is the variability in stock prices that result from factors peculiar to an individual company. While the systemic risk, as also known as beta, is the risk that cannot be eliminated by diversification. It is because all stock move more or less in tandem that even diversified stock portfolio are risky.
What do you think? Is it possible to eliminate all risk?
No, diversification cannot eliminate all risk. Based on capital asset pricing model published by Sharp, there are some part of a securities risk that can be eliminated and some cannot.
Could you explain a bit more about CAPM?
Well, CAPM theory, basically the continuation of modern portfolio theory, introduced the new factor called beta, or we know as systemic risk. That is number that express how closely an individual stock matched the behavior of the overall stock market in the past. The beta calculation is essentially a comparison between the movement of an individual stock and the movement of the market as a whole. The total risk of each individual security is irrelevant. The higher the systemic risk of an individual stock, so does the return an investor can expect.
Is there any effect of beta and return on investment in reality?
Well, based on the research by Pharma Friends, they found out that the relationship between beta and return is essentially flat. The beta measure of relative volatility does capture at least some aspect of what we normally think of risk. Investors should be aware that even if the long-run relationship between beta and return is flat, beta can still be useful investment management tool. Well, to sum up, the stock market appears to be an efficient mechanism that adjusts quite quickly to new info. Neither technical analysis nor fundamental analysis seem to yield consistent benefit. Obviously, the only way to obtain higher long-run investment return is to accept greater risk. Unfortunately, a perfect risk measure doesn't exist. The actual relationship between beta and rate of return has not corresponded to the relationship predicted in the theory during long period of the 20th century. Moreover, betas for individual stocks are not stable over time, and they are very sensitive to the market proxy against which they are measured.
So, basically, is the market predictable after all?
Well, market reviewed all the recent research proclaiming the demise of the efficient market theory and concluded that such obituaries are greatly exaggerated and that the extent to which the stock market is usefully predictable has been vastly overstated. He showed that buying and holding a broad-based market index fund is still the only game in town. Although market may not always be rational in short term, it always is over the long haul.
What do you mean by saying markets are efficient?
Market can be efficient if the stock prices exhibit greater volatility than can be explained by fundamentals such as earning and dividends. Above all, we believe that financial markets are efficient because they don't allow investors to earn above average return without accepting above average risk.
What are the methods that people try to discredit the efficient market theory?
Well, basically, there are several methods that people do. One of it is dogs of the dome. This is the out of favor stock eventually tend to reverse direction. The second one is January effect. Stock market return have tended to be especially high during the first 2 weeks of January. The effect appears to be particularly strong for small firms. The last one is the hot news response. It is believed that stock prices underreact the new. To sum up, market valuation rests on both logical and psychological factors. Stock prices display a remarkable degree of efficiency. Info contained in past prices or any publicly available fundamental info is rapidly assimilated into market prices. Prices adjust so well to reflect all imported info that a randomly selected and passively managed portfolio perform as well as or better than portfolio selected by the experts.
Could you explain about the advice from this book? Cover thyself with protection.
About that, I will try to explain. There are 4 points to conclude about this. One wrote that the first one once wrote that patience is a necessary ingredient of genius. is also a key element in investing. You can afford to pull your money out at the wrong time. You need staying power to increase your odds of earning attractive long-run return. Therefore, you have to have non-investment resources such as medical and life insurance to draw on should any emergency strike you or your family. The second is about category of life insurance. The first one is about high premium policies that combine an insurance scheme with a type of saving plan. They do have some advantage earning on the part of the insurance premium that go into the saving plan accumulate tax-free, but they entail high sales charge. The second are low premium term insurance that provide death benefit only with no build-up of cash value. The third thing, take the time to shop around for the best deal. You do not buy insurance from any company with an EM base rating of less than A. The last thing, in addition, you should keep some reserve in a safe and liquid investment. Every family should have a reserve of several months of living expense to provide a cushion during an emergent or hard time.
What degree of risk you are willing to assume, and what kinds of investment are most suitable to your tax bracket?
JP Morgan once had a friend who was so worried about his stock holdings that he could not sleep at night. The friend asked, "What should I do about my stocks?" Morgan replied, "Sell them to the sleeping boy. Every investor must decide the trade-off he is willing to make between eating well and sleeping well. High investment rewards can be achieved only at the cost of substantial risk-taking." Step 1. Find your risk tolerance level, a slipping scale on investment risk and expected rate of return. It is critical that you understand yourself before choosing specific securities for investment. Perhaps the most important question to ask yourself is how you felt during a period of sharply declining stock markets. If you became physically ill and even sold all your stock rather than staying course with a diversified investment program, then a heavy exposure of common is not for you. Step 2. Identify your tax bracket and income need. You have to check how much tax you have to pay for your investment returns. For those in a high marginal tax bracket, there is a substantial tax advantage from tax exemption. Example, municipal bonds and stock that have low dividend yield but promise favorably tax long-term capital gains. If you are in a low tax bracket and with a high current income, you will be better off with taxable bonds.
What are short-term investment instruments that can at least help you stand up to inflation?
About that, maybe Jati will help me.
To answer your questions, there are 4 short-term investment instruments. The first is money market mutual funds. They provide the best instrument for many investors' needs. They combine safety, high yields, and the right to withdraw money with no penalty attached. Most funds allow you to write large checks against your fund balance. The second, money market deposit accounts provided by banks. Money funds yields tend to higher than the bank accounts. In addition, the money funds allow an unlimited number of checks to be written against balances. The third is bank certificates. You need at least $10,000 before you can buy, and you can write checks against the certificates. There is a substantial penalty for premature withdrawal. Finally, the yield on bank certificates is subject to state and local taxes. The fourth is tax-exempt money market funds. They are useful for investors in high tax brackets.
Yeah. What kinds of bond purchases that we have to consider?
The first one is zero coupon bonds. The purchaser is faced with no reinvestment risk. The main disadvantage is that IRS require that taxable investors declare annually as income a pro rata share of the dollar difference between the purchase price and the par value of the bond. The second is no-load bond funds, because bond markets tend to be at least as efficient as stock markets. I recommend low expense bond index funds, which generally outperform actively managed bond funds. In no event should you even buy a load fund. The third is tax-exempt bonds are useful for high-bracket investors. If you buy bonds directly rather than indirectly through mutual funds, I suggest that you buy new issues rather than already outstanding securities. New issue yields are usually a bit sweeter than the yields of the seasoned outstanding bonds, and you avoid paying transaction charges on new issue. And the last one, inflation index bonds. Tips: Treasury inflation protection securities. Although stocks have bestowed generous long-run returns, they usually suffer during inflationary periods. Tips will offer higher nominal returns, whereas stock and bonds prices are likely to fall. They are not ideal for taxable investors and are best used only in tax-advantaged retirement plans.
What are the critical factors of a very long-run return from common stocks?
They are driven by two critical factors: the dividend yield at the time of purchase and the future growth rate of earnings and dividends.
What is the role of inflation?
The role of inflation is the dark horse in any handicapping of financial returns. In principle, common stocks should be an inflation hedge, and stocks are not supposed to suffer with an increase in the inflation rate. In theory, at least, if the inflation rate rises by 1%, all prices should rise by 1%, including the values of factories, equipment, and inventories. Consequently, the growth rate of earnings and dividends should rise with the rate of inflation, so will the required return on common stocks. However, very high inflation rates are very bad for economy. When price rise by 10%, all prices do not rise by the same amount. Rather, relative prices are far more variable at higher levels of inflation.
What are asset allocation principles?
The principles are: first, history shows that risk and return are positively related. The second, the risk of investing in common stocks and bonds depends on the length of time the investments are held. The longer an investor's holding period, the lower the risk.
Can you explain more?
Of course, thus your stage in the life cycle is a critical element in determining the allocation of your assets, and also a substantial amount, but not all, of the risk of a common stock investment can be eliminated by adopting a program of long-term ownership and sticking to it through thick and thin, the buy and hold strategy. And the last one, the longer an individual's investment horizon, the more likely it is that stocks will outperform bonds. Over any single year period, there is a 1 out of 3 chance that bonds or money market funds will outperform stocks. But if one looks instead at different 20 or 25-year holding periods, stocks are the performance winners every time.
I think this is my last question. What is the multi-year step?
The market step. Sometimes closed-end funds have attractive discounts. During the late 70s, the discounts ran as high as 40%. My own explanation for the discount ran in terms of unexploited market inefficiency, and I argued investors could take full advantage of the opportunity for as long as it lasted. Discounts have narrowed significantly on US closed-end funds. I think the fundamental reason for the narrowing is that our capital markets are reasonably efficient. The market may misvalue assets from time to time, creating temporary inefficiencies. But the financial laws of gravity will eventually take hold and true value will out. If discounts of 20% or more exist, it is time to buy closed-end funds.
Okay, thank you for the explanation of the book.
You're welcome.